And I'm Paul Black with Black CPA Review. And today we're going to take a look at how to calculate the break-even point for a single product. So we're going to do a little break-even analysis. And you're going to need to know this concept for the Beck exam, okay? And on the Beck exam, you're going to need to know how to find the break-even point for a single product and for a mix of product or for multiple products. In this video, we're going to only look at the break-even point or calculating the break-even point for a single product. In a later video, we'll look at a mix of products, okay? So in order to find the break-even point for a single product, the best place to start is by having a working definition of break-even analysis, all right? So break-even analysis allows management to determine either a number of units or a dollar amount that the company must sell in order for the company's revenue to equal their expenses, all right? And any amount over that break-even point is considered profit, all right? And again, the break-even point is the point in which the expenses equals the profit, okay? Or equals your revenue. Now, let's go ahead and take a look at how to calculate the break-even point. And in order to do that, you need a formula, all right? So the first formula we're going to look at, all right, is your break-even formula that will tell you the number of units that must be sold in order for the company to break even. And the break-even formula is your sales price times X equals variable cost times X plus fixed cost, all right? And on the CPA exam, the question is going to give you every single component of the formula except for X. You're solving for X. And again, X is the number of units that have to be sold in order for that company to break even, where the revenues equal the expenses. All right? Now, we can go ahead and take a look at an example. And it says here that ABC Company produces a product that sells for $4. The variable costs are 75 cents per unit, and fixed costs for the company are $12,000, all right? So, the product sells for $4. You have variable costs of 75 cents, and you have fixed costs of $12,000, all right? So using our break-even formula, you're going to put the sales price, all right, $4, and that's times X. And this is going to equal your variable costs, 75 cents times X, all right, plus your fixed costs, okay? And what we're saying here is that the sales price times the number of units sold has to equal the variable cost plus the fixed cost, all right? So we're solving for X, all right? So you got 4X equals 0.75X plus 12,000. It's going to give you 3.25X, right? You subtract 0.75 from 4. Gives you 12,000 here. So we've broken our formula down to 3.25X equals 12,000. All right, so you're going to divide by 3.25. It's going to be X equals 3,000. It's 3,692 units. All right. So using the break-even formula, all right, which is your sales price times X equals variable cost times X plus fixed cost. So using that formula and the information we were given in the problem, you can determine that the company has to sell 3,692 units at $4 per unit in order for them to break even, okay? Now, in the previous example, this example here, we determined the break-even point as a number of units that have to be sold, all right? Now, it's also possible to determine the dollar amount that the company must bring in order to break even, all right? So to do this, we have to calculate what's called the contribution margin per unit, all right? And to calculate the contribution margin per unit, we're going to use the following formula. All right. So the contribution margin per unit equals your sales price minus your variable costs. Using our example from before, you had your sales price of $4. All right. You subtract variable cost, gives you a contribution margin of 3.25. Okay? And the contribution margin is the amount of the sale that goes to directly offset fixed cost. So it's the price, it's the sales price less variable cost. The remainder is your contribution margin. The remainder is the amount that goes to offset variable costs. All right? So, in our previous example, you then took the $12,000 of fixed cost, divided it by 3.25, and you came up with 3,692 units. All right. This was our break-even point for our previous example. You took the contribution margin and divided it into your variable or your fixed costs. Okay. So now that you know how to calculate the contribution margin, we can look at another formula that's going to tell you the amount of dollars that the company needs to bring in order to break even. All right. And that formula, the dollars needed to break even, equals fixed costs divided by your contribution margin per unit divided by sales price. Okay. So using the same facts from before, we can calculate the dollars, all right, needed to break even. All right. So the dollars needed to break even equals your fixed costs divided by the contribution margin, which is your sales price less your variable cost, so 3.25, divided by your sales price, which is $4. All right. So this is the formula, all right, fixed cost divided by your contribution margin divided by sales price. This is the formula you need to memorize in order to calculate the dollars needed to break even. All right. So we've got 12,000 divided by 81.25%, which is $14,769. All right. So this company here needs to bring in $14,769, all right, in order to break even. So their expenses equal $14,769, the revenue equals $14,769. So using our three different formulas, your break-even formula, your contribution margin, and your dollars needed to break even formula, we can determine that this company needs to sell 3,692 units, or in other words, $14,769 in order to break even. All right. If they sell an additional unit beyond this amount, that's considered profit. Right now they're breaking even. If they sell another unit, they've got profit. And that profit is your sales price of $4 less your variable cost of 75 cents. So your profit for each additional unit sold beyond the break-even point is $3.25. All right. So using those three formulas we went over, all right, that's going to be your break-even formula, sales price times X equals variable cost times X plus fixed cost. Your contribution margin per unit, which is your sales price less your variable cost. And your dollars needed to break even, which is your fixed cost divided by contribution margin per unit divided by sales price. So using those three formulas, you're going to be able to answer any question on the CPA exam regarding single unit or single product break-even analysis. All right. So the best way for you to actually prepare for this concept on the Beck exam is to memorize these three formulas. Put them on a flashcard and make sure you got them down. Once you've got them down, start applying them to multiple choice questions, all right, just to make sure you've got the concept down. And that's the best way to study for break-even analysis of a single product for the Beck exam. If you have any questions and you're watching on YouTube, post a comment. We'll get back to you. If you're watching on our website, give us a call or email us, and we'll give you a hand. Otherwise, good luck studying for your exams. And again, we are Black CPA Review. Let us know if you need anything.